The next question was 2026 projections for the CRE market. So after a year of a lot of uncertainty with the tariffs, tightening immigration flows, and periods of financial market stress, the U.S. economy still proved more resilient than expected. So for 2026, the outlook for the U.S. commercial real estate market is shifting from resilience to optimism. For the office sector, we're seeing continued flight to quality, where there's a strong demand for high quality, amenity rich, modern spaces, Class A properties. And we're seeing falling vacancies and rising rents in this class. However, there's a bit of a bifurcation as the older, less equipped Class B, C buildings continue to struggle. That said, this stock is slowly being removed as we're seeing conversions to residential and other uses. However, the U.S. office construction pipeline is at its lowest level since the 1990s, and key markets including San Francisco, San Jose, Austin, New York, Atlanta, Dallas, and Nashville all reported strong positive absorption in 2025, meaning there's more space being leased or sold than vacated. And this is supported by all the AI expansion and other job growth. In Chicago, 2025 still saw negative net absorption, particularly in the central business district. But the severity of the negative trend is lessening. And again, there's the strong demand for the modern, amenity-rich Class A spaces, but it's those older buildings that continue to struggle. And in Chicago, like in the rest of the country, there is a significant slowdown in construction, which means that space will only continue to tighten. So in industrial market, it is stabilizing. It's moving towards pre-pandemic norms, with overall moderate rent growth. There's a supply slowdown from that peak 2022, 2023 levels, but still high demand from e-commerce, AI, manufacturing, and intensifying competition for land from those data centers. And although coastal port markets face softening rents, more inland hubs such as Dallas, Chicago, and Phoenix continue to see rent growth and robust occupier demand for industrial. And then retail, the occupancy rates remained pretty strong in 2025 as there continues to be a historic low level of new construction for retail, which hasn't kept pace with the demand. And despite all the big box closures that Bill was mentioning, there was healthy rent growth in grocery anchored centers, as well as experiential retail, such as service and entertainment-based retail, and also high-end. And the outlook for 2026 in retail also shows optimism driven by the lower interest rates, stabilizing inflation, and investors favoring those things I just mentioned, the grocery anchored luxury and lifestyle retail. And they're expecting increasing transaction volume in those areas.
Terrific. I've got a couple of things to add there. Number one, on the office side, Diana is absolutely correct as there's been a huge flight to quality. However, we're now seeing that those super Class A brand new buildings are really filling up, especially with larger blocks of space no longer being available. So now the larger end users who are looking for, 50 to 100, 150,000 square feet, they're now starting to go down to just the normal A's or the Class B pluses. So now some of the lower end buildings outside of that super high end are starting to see a bit more demand, a little more foot traffic, tours are up, leases are starting to be on the rise. And so we are starting to see that demand shift from the super Class A's coming back down to just the normal Class A's and Class B pluses because there's no large blocks of space available in the super Class A properties. On the industrial side, I've been mentioning this many times, it's really a tale of two different types of product. And that is the spaces 250,000 square feet and above, the big block spaces. Those now have a vacancy rate of around 6 to 7% across the nation, whereas spaces of 200,000 square feet and below, those only have a 3% vacancy. So if you're a normal business, if you're not Amazon or Procter & Gamble or Kimberly-Clark or Target, most businesses are looking for that 50 to 200,000 square feet. You really need a good broker that's going to help prepare you to being able to move quickly, making quick decisions, getting the due diligence done in a timely manner, and really being able to quickly go through your checklist on your process to make sure that you secure the property that's right for your business versus the 5-10 other businesses that are out there looking at the same property. Last thing I'll add is on the retail side, a big part of driving demand these days on retail is experiential retail. We no longer go to a store to buy a product that we can get on Amazon. And so where people are going to retail is to throw an axe, jump on trampolines, do different things that are an actual activity, like a salon service as well. You can't order a hair blowout online. You have to physically go into a location and get that done. And so really what's been carrying the day in retail has been experiential.